Hey everyone, and welcome back to Am I Catching a Falling Knife? I'm Dave, and today we're diving into a stock that's seen a pretty significant pullback recently, Palantir Technologies, ticker symbol PLTR. Now, the charts are showing us a sharp drop, and we need to understand why. The core narrative we're going to dissect today is intense skepticism surrounding Palantir's valuation, with many arguing it's out of sync with the company's fundamentals, despite its advancements in the AI space. So, what exactly does Palantir do? They build and deploy software platforms primarily for the intelligence community, helping with counterterrorism investigations by identifying hidden patterns in vast datasets. Their flagship platforms are Gotham, which helps analysts and operators plan real-world responses, and Foundry, a central operating system for organizational data. More recently, they've introduced Apollo for cross-business software delivery and the Artificial Intelligence Platform, or AIP, to unify access to large language models. It's a company with deep roots in data analysis and a significant push into AI. Now, let's talk valuation. We've run a discounted cash flow model, or DCF, as a baseline. Based on their current earnings per share of 0.30 and projecting a strong EPS growth rate of over 40% for the next 5 years, with a discount rate of 9.5% and a terminal growth rate of 2.5%, our base case DCF fair value comes out to $18.92. This is where the earnings potential, theoretically, should place the stock. But here's where the narrative kicks in and significantly shifts things. The market skepticism is largely centered on Palantir's extremely high PE and PS ratios. Many see these multiples as detached from the company's actual financial performance, even with their AI progress. There's a broader market rotation happening away from high-growth tech, and concerns are surfacing about whether companies are actually seeing strong returns on their massive AI investments. Reports suggesting this lack of tangible return for many companies add fuel to the fire. This skepticism is reinforced by analyst downgrades and price targets that suggest limited upside or even further downside from current levels. We're also hearing chatter about smart money or institutional investors selling their Palantir shares, viewing it as a retail favorite that might be overly optimistic. How does this narrative impact our valuation? The core of this skepticism isn't about Palantir losing current revenue, but about how the market prices its future earnings. The narrative suggests investors are demanding a higher risk premium and are less willing to pay a premium for future AI growth at current multiples. This skepticism directly impacts both the commercial and government segments, as it questions the future value derived from these operations in the current market environment. Because of this, we've adjusted our valuation. We're applying a 15% haircut to our base case DCF fair value to reflect this increased skepticism and a lower perceived willingness to pay for future earnings. This leads us to our narrative-assisted fair value of $16.08. This is the valuation that attempts to incorporate the current market sentiment. Given this analysis, we're looking at potential buy levels. These are points where the stock might represent a more compelling entry for those willing to take on the risk. Our Level 1 consideration is around $12, Level 2 at $85, and a deeper dive might be considered around $50. So, that's Palantir. Remember, this is not financial advice. Always do your own thorough research and understand your own risk tolerance before making any investment decisions. Thanks for watching Am I Catching a Falling Knife? And I'll see you in the next one.